Let's talk about 2020 and 2021. What a year it was in 2020. If you're actually to look at it in a vacuum without sort of knowing what happened, you would say, what a great year. It must have been tremendous economic growth and low unemployment, and what a great year. Probably one of the best years ever, or close to one of the best years ever. But we know that actually it was such an interesting year. So let's take a look back at the market returns for the year and put some context to that and talk about what some of the big surprises were during the year.
Yeah, if we take a look at market returns, the S&P 500 ended the year up almost over 18%, which you think about everything the global economy went through, and companies and individuals. 2020 was a crisis year for much of the world. To think stocks could rally to that magnitude. And it wasn't just in the US. I mean, there's a lot of green on this board across most asset classes. Interest rates fell, credit spreads tightened. And if you just think about the returns of a diversified portfolio, when we were having a similar video shoot like this at the beginning of 2020, we were saying, wow, 2019 was one of the best years ever for a diversified portfolio. And how much lower can interest rates go, and how much higher can the stock market go in 2020? And then everything that happened, and what you get is actually another excellent year for a diversified portfolio, particularly given all things considered.
And some of the big surprises during the year, I mean, obviously the virus was a huge unknown and a big surprise, but there were some tremendous things that happened during the year. I mean, just think about the fiscal response, the monetary response, and the pace at which those responses were implemented was incredible. Given where we were at the start of the pandemic and where we are now at the end of 2020.
Yeah, the response globally by policymakers, by healthcare officials, it was almost as strong as the crisis itself in many instances. To think the Fed doing what they did, unprecedented action taken in an unprecedented short amount of time, and then to see Congress pass the CARES Act and the magnitude of that bill and how quickly it was passed, especially when you compare the size and speed of that bill to the relief during the last economic recession in 2008, which was far smaller and took far longer. The response was as big of a surprise to markets as the pandemic was in many ways.
The medical response was tremendous. So the ability to handle these cases, you heard about the media, but there were quite a large number of hospitals that were overrun with patients, and just states managing this. That response was also tremendous. I don't remember a time where you would think that this type of volume could be handled in the hospital system. Yeah. And then equally, the development of a vaccine in basically 9 months.
Record time, yeah. I mean, prior to COVID vaccines, vaccinations weren't things that happened quicker than 5 years' time. And prior vaccinations, it's not really a profitable business endeavor for a lot of pharmaceutical companies to create something that cures people, because then you get no more revenue from that business line, right? So to see the technology, a lot of these new technologies that were just on the cusp of, like messenger RNA vaccine technology, and to see it all play out, and to have multiple vaccines approved for emergency use authorization within 9 months is just, I mean, it's totally unprecedented. Yeah. And you could tell that was a huge shock to markets. I remember having multiple video shoots in the summer and the fall saying, hey, it looks like we might have multiple vaccines approved for year end, and it seems like the market isn't paying attention to this. And then when we got the Pfizer news in early November with the 94% effectiveness, you saw the market shot up and had a very strong Q4, 12% during the final quarter of the year, most of that based on vaccine news.
Yeah, absolutely. I guess one of the other big surprises to me personally, and I think what we're doing right now was the ability for businesses to transition to a virtual work from home environment where probably estimates of around 70% of the working population or more went to a full remote work environment, and that businesses successfully made that transition. I think we leapt forward in infrastructure development. We probably got 3 years forward in 6 months here. Who knows what could have happened and how this could have sort of played out. And we're still not out of the woods. The vaccines have been developed, and now it's about getting them out. And there's obviously some challenges with that. And there's been mutations, so there's still a lot of unknowns out there and a lot of work to be done. But as we think forward and look forward, it looks like the sort of the light sort of at the end of the tunnel here. All right, so it's time to turn the page, as the famous Bob Seger song states. And as we look at 2021, it has a feeling to me, absent what happened at the start of the year, that we'll see more moderation this year. It'll be hopefully boring, and boring is good. That we'll see a lot on the political side. We'll see more moderation, a lot less polarization, hopefully, and sort of the country will come together and sort of fight the remaining elements of the virus and get the economy back on track here. So there's a lot to look forward to in 2021. Let's talk about our investment outlook for 2021. And so why don't you lay out for the folks our themes and how we developed our themes here.
Yeah, so every year when we do our annual investment outlook, we like to put some type of a relatable theme around our viewpoints to make it sort of easier to consume. So this year, as we were thinking about the setup for 2021, the movie Back to the Future came to mind. Classic movie, 35th anniversary was just in the rear view here, and basically the idea is that all anybody wants to do in 2021 is to just go back to the way things were, how they were in 2019 and their old lifestyle. But the reality is that events have transpired during 2020 that will most likely change our futures forever and how we live our lives, and change the dynamics in markets and public policy and so on and so forth. So that's sort of how we and we took that back to the future theme and relayed that into our base case, bear case, and bull case for next year, and sort of carried that theme throughout. The base case we call stuck at 87 miles per hour. And if you recall the movie, the quote was, when this baby hits 88 miles per hour, you're going to see some serious expletive, some serious stuff. Implying that when the DeLorean gets up to 88 miles per hour, that's when we can go back in time and travel through time. Our view is we're probably not going to hit that 88 miles per hour this year. And what that means in terms of the virus and the vaccine and the economy is we're going to make progress on moving back towards how we used to live our lives. The vaccines are going to do a lot. We're probably going to rapidly approach herd immunity, but we're not going to get to the point this year where we can definitively declare victory over the virus. That is unlikely. There are going to be disruptions in distribution of the vaccine, delays, reluctance to vaccinate. There are probably going to be frequent case flare-ups within pockets of the country, and most policymakers are going to probably err on the side of safety and continue to mandate things like wearing masks and have some level of phased reopening, but no victory is declared. So we're never going to hit 88 miles per hour, but we're going to get close this year, hopefully, on the virus and the vaccine front.
And what does that mean in terms of sort of how we think about the economic growth for the year and unemployment and potentially market outcomes?
So the virus and the vaccine, we don't need to declare victory in order to have a good year in terms of economic results, in terms of decreasing unemployment, and in terms of the equity market. We really don't need that. And the key thing is here, as long as, if there are any negative economic developments, as long as the virus can still be blamed as the proximate cause for those things, then policymakers are going to feel compelled to provide more stimulus, more fiscal stimulus, central banks providing more stimulus to stabilize markets. And so in this scenario where we're not declaring victory over the virus this year, and there probably are going to be economic hiccups, more stimulus will come because it will still be blamed on the virus. And if more stimulus comes and more money is created, that can do enough to make sure we have a decent year in terms of the economy. You know, in our base case, we're expecting full year GDP growth of 4%. That's a pretty strong year. It's coming off of a low base, but that's a pretty strong year. It's a good recovery, and we think that's definitely enough, combined with the stimulus backstop. That's enough to propel equity markets higher and reduce unemployment.
Yeah, and additionally, it doesn't anticipate aggressive tax policy from the new administration until sort of we've cleared this hurdle. Is that correct?
Yeah, exactly. The concern, and we're sort of, you know, getting into the bear case, is actually that the recovery is so strong, and the health situation is totally solved, that policymakers feel that it's appropriate to start withdrawing stimulus and solving longer term problems like our deficit, income inequality, things like that. That would be pulling away the punch bowl
Right.
too soon, most
soon.
likely too soon. That would be a policy error. So that's why in this base case, you know, we don't think those things are on the table. It's possible they'll be discussed, but unlikely to see action in terms of tax increases to try to shore up the deficit or solve income inequality, or anything like rate hikes, interest rate hikes, or shrinking of the central bank balance sheet to try to stem a potential runaway inflation. We just don't see that in the cards this year. The bear case we call the fading pre-pandemic Polaroid, and there's the famous scene in Back to the Future, the first Back to the Future, where Marty McFly is looking at a picture of himself and his brother and his sister, and he's seeing himself fade away, fade out of the picture, because he's doing something in the past that is permanently altering the future, and maybe he would never even be born. So taking that idea is, everybody wants to look back at the pictures of themselves and the things they were doing in 2019 and 2018, and we just want to go back to that. But in this bear case scenario, there's policy mistakes as well as sort of a false dawn on the virus and vaccine front that basically means we're going into seemingly permanent lockdown, and so we're never going to go back to those things, how we lived our lives in 2019 and 2018. So definitely the bear case scenario. We don't assign a huge probability to this scenario because, as you see as we talk through it, you know, with this much money in the system, and the economy already beaten down so much, it's really going to take a confluence of events all sort of hitting at just the wrong time to really pose a tremendous amount of downside risk to the economy and the markets. So we don't assign a big probability, but basically how the scenario plays out is you start off the year thinking we're making good progress on the health side of this pandemic. Maybe the vaccination effort starts going smooth, maybe for seasonal reasons, case counts start to fall. There are some therapeutics that seem to be working out. And policymakers, so global central banks and politicians, view this as, all right, this virus situation is seemingly under control. I'm going to change my focus on some of the long-term consequences of what's happened here in the past year. And I'm going to focus on increasing taxes to try to solve income, wealth inequality, and the fiscal deficit problem, at least get that pointed in the right direction. And central banks thinking, well, I need to make sure this doesn't result in runaway inflation, all this money printing, so I'm going to start shrinking my balance sheet. Maybe I'll have some ammunition for the next crisis. And those, in our view, would be policy mistakes if they were done this year. So if you get those policy mistakes at the same time that sort of the virus situation takes an ugly left turn, and maybe there's a mutation in the virus that makes vaccinations less effective or therapeutics less effective, that confluence of events we think would be definitely characterize the bear case, and we assign about a 10% probability to that. type of a scenario.
And the good news is that the current leadership understands, and the incoming administration understands all of these things, and we fought this war, or at least this battle, once, so we'll be able to fight it hopefully even better if it does materialize. And the initial, I guess, signaling from the new administration is that their selections have been very dovish, so that the accommodations fiscally and monetarily will continue to support us through this process.
Yeah, that's exactly right.
So let's talk about the bull case.
The bull case, a little higher probability than the bear case. We put it at about 20%. And this one called 1.21 gigawatts of money at 10:04 p.m. And the idea is from the movie, if you can get the DeLorean to the clock tower at exactly 10:04 p.m., lightning will strike and you'll get 1.21 gigawatts, which we know is actually supposed to be gigawatts, of power into the DeLorean at just the right time. So you can see it's sort of threading the needle. And ultimately, it's you pump the economy and the markets full of too much money, 1.21 gigawatts. I don't know how much that is, but it's too much, and very late. So too much, too late, which is typically how stimulus works, particularly in Western economies. And so everything sort of goes right. You get a smoother than expected global vaccination effort, improved therapeutics, basically allow politicians to roll back restrictions with minimal consequences on the health side. Consumers and businesses have their balance sheets, most of them on average are relatively healthy. Consumers have pent-up savings, and in this environment they feel very comfortable spending down some of those pent-up savings to make up for lost experiences from last year. And you combine that with politicians and central bankers taking the view that it's a much greater risk to withdraw stimulus too early than it is to keep this going for too long and create inflation and other longer term consequences. And so politicians and central bankers don't even think about touching the brake pedal. In fact, maybe they even push a little bit more on the gas and provide more stimulus. This scenario, given the election results for the two Senate runoffs, these probabilities were struck prior to those results, but it probably increases the probability of that bull case scenario just slightly, because we think, a fully Democratic Congress with a Democratic president, there will be no pressing on the brake pedal, most likely this year. In terms of stimulus, and once again, we think tax increases in this bull case scenario are off the table for this year, for 2021. Right.
Yeah. So let's tie all that back to our base case themes, and how there's obviously could be variations in degrees of magnitude on any of these things, but just tie us back through the base case themes as we see them.
Yeah. The key themes, so sort of our tagline for the base case is fundamentals have nothing to do with it. So if you look at traditional fundamental metrics of the economy, of the equity market in terms of earnings, in terms of valuations, they have nothing to do with what happened last year in markets. And this base case in some ways is really a continuation of that, is we're going to be dealing with these health consequences, and in the meantime, markets, consumers, here's some money. And so fundamentals probably still won't have anything to do with it, except for the fundamental that if more money is created, it has to go somewhere. So that's sort of the tagline for next year in our base case. For the virus and the vaccine, we have a quote, which is not assigned to anyone in particular. I forgot I was even wearing a mask. And the idea is, yes, the situation on the virus will get better, but things like wearing a mask, things like some sort of phased reopening, you're probably going to see that throughout the year. We won't declare victory. Global central banks, traditionally, their mandate has been price stability and full employment. And we think that has gone by the wayside. Interest rates are already at 0 or lower across the world for most global central banks. And they have, in many cases, more than doubled their balance sheet. So they're not really targeting full employment and price stability at this point. We think it's more they're targeting market stability and full debt monetization. meaning those are their primary roles next year, making sure that the market stays stable and that asset prices stay elevated, because that will keep any economic situation from turning into a balance sheet recession, which we know everyone wants to avoid. And then full debt monetization. Governments are saddled with a tremendous amount of debt, and they need to be able to refinance it, roll it over at very low interest rates. And where's the demand for all that paper going to come from? Global central banks. So they need to be there to make sure that governments can roll over their debt, so governments can continue to provide fiscal stimulus. That will be their new role for next year and probably for the foreseeable future. And then on fiscal policy, and Will, you mentioned this a little earlier, no hawks left on Capitol Hill. There really aren't any budget hawks left. The conversation about whether or not the government can afford the types of things that are going on right now and all the money that has been spent and all of the stimulus checks, that conversation is evolving dramatically. And it's not even can we afford it, it's just is there going to be inflation? We know we can afford it because the Fed will clear any check, any payment that the government authorizes. So we know we can afford all of this stimulus. It's just, will there be long-term repercussions? So there really are no budget hawks, no deficit hawks left on Capitol Hill, and really very few hawks at the Federal Reserve either, especially with Janet Yellen becoming Treasury Secretary. There are just no hawks left. So more money is sort of the path of least resistance.
Yeah, and as we've stated multiple times throughout the year in our videos, there is still no alternative to stocks. Bonds are more expensive, cash is more expensive, and so there still is no alternative. And until we see one, there's going to be demand, right?
Mm-hmm. Yeah, I mean, any traditional valuation metric for stocks in a vacuum says they're extremely expensive, but they're actually far cheaper than the alternative. And that's because interest rates are at record lows. And central banks aren't even thinking about raising rates. So in order for stocks to look unattractive relative to bonds, probably the path of least resistance is not that interest rates are going to rise materially. Probably it'll be the opposite, that stocks are actually going to get far more expensive to the point where now their earnings yields come down to levels comparable with bonds and other safe assets. Yeah. And you want to be a part of that. When that happens, you want to be invested in equities, because we're talking about, if the S&P 500 were to get on par with a 10-year Treasury note in terms of earnings yield versus yield on the 10-year Treasury note, you're talking about 60+% upside in equities just from the valuation adjustment, regardless of the earnings situation. So there is room to run. You just need to change your point of reference.
And I think as we've been researching, we're expecting that stock buybacks will resume at some point in the future, absent any political intervention, that companies will resume buybacks and it start to improve dividends. So we should see more demand for stocks just on those two items alone.
Right. Yep. And the other elements here, we have our forecast for the base case. Inflation, we expect to hit 2%, but we don't think the Fed is going to do anything about it. Even if inflation were to hit 2.5%, 3% this year, we think they're likely to look through it and call it transitory and not budge. So typically what we do is we set our estimate for Fed interest rate increases or cuts, but that just doesn't make any sense anymore. They're not budging. They probably won't budge for a very long time. So instead, we changed it to the growth in the balance sheet. And we expect by year end, Fed assets could reach $8 trillion, which would be growth of their balance sheet of another 8%. You're getting to the law of large numbers here. 8% on this big of a balance sheet is a ton of money. Right. You're talking about the central bank balance sheet approaching 40% of GDP. Just huge, huge numbers.
Well, I guess just before we end this section and move on to the next, unemployment and the idea on getting people back to work. Provide the viewers our thoughts on where we see that trending.
It seems like from this point that the majority of folks who were laid off or furloughed that were in sort of non-structurally challenged industries have been brought back. Sort of the low-hanging fruit, those folks have come back to work. We've worked through about half of the job losses that happened. Half of those people have been brought back. And if you look at the makeup of those that are currently unemployed and the long-term unemployed, a lot of them are in areas of the economy that might not come back for a long time. Hopefully they start to come back next year. We're talking about leisure, hospitality, bars, things like that in the service industries. Hopefully they start to come back next year. We hope with the vaccination effort that they will start to come back this year. And if it's not through successful vaccinations, it's probably through lockdown fatigue.
Mm-hmm.
There are plenty of towns
There's a
around
lot
where
of that.
you can still go to a bar even though you shouldn't. But so we think the unemployment picture will continue to get better, but we're not going to get down to 4% unemployment next year. A lot of those jobs, unfortunately, that haven't been brought back yet are going to be permanently lost.
Right.
And those people, unfortunately, if they're going to stay in the labor force, probably need to retrain themselves, learn a new skill set, find a new industry, and hopefully there are opportunities for that. But we're not going to get back to full employment next year. Estimates are it might not be till 2023, 2024, beyond.
This year is going to be quite interesting, so stay tuned to our channel, and thanks for watching. And anything you want to add, Mike?
No, thank you very much.